By watching this video to the end, you will understand how a potential Bank of Japan rate hike to 1.25% could trigger a major carry trade unwind across global markets. As the yen sits near 40-year lows against the dollar, Japan stands at an unprecedented monetary inflection point. Swap markets are pricing over a 70% chance that the Bank of Japan hikes rates to 1.25% while the Federal Reserve keeps policy on hold. This rare divergence threatens to upend years of cheap yen-funded trades across global equities. To grasp why a BOJ rate hike to 1.25% matters so deeply, we must look at Japan's monetary trajectory over the past 3 decades. The Bank of Japan has maintained ultra-loose monetary policy for decades to combat deflation. Even at its current benchmark rate of 1%, rates are at their highest level in 30 years. However, this historic low-rate regime came at a massive cost. Massive interest rate differentials between Japan and the United States pushed the yen to 40-year record lows. The Japanese government deployed over $70 billion in direct foreign exchange interventions to stem currency weakness, but those intervention effects quickly faded. Consequently, market participants are watching whether Tokyo will finally end its low-rate era or yield to external political and economic pressures. If the BOJ proceeds with a rate hike to 1.25% while the Fed remains on hold, it will create an unprecedented policy gap that directly challenges the structural carry trades that have buoyed global stock markets for years. Let's examine the hard numbers driving this policy showdown. Right now, swap markets are pricing roughly a 70 to 72% probability of another BOJ rate hike by October. This comes as the yen remains pegged near 40-year lows against the US dollar, proving that previous government interventions totaling more than $70 billion failed to secure lasting currency stability. The core issue lies in timing and alignment. Markets are preparing for a potential double catalyst next week, where the Federal Reserve and Bank of Japan monetary policy decisions coincide with major corporate earnings announcements. If the Fed delivers a tight or hawkish stance on Wednesday and the BOJ delivers an unexpected surprise hike to 1.25% on Thursday, both sides of the global funding trade get hit simultaneously. Traders vividly remember August 2024, when a modest 15 basis point surprise rate hike by the Bank of Japan triggered an immediate 12% drop in the Nikkei 225 index and sent global volatility spiking. With policy rates currently sitting at 1%, stepping up to 1.25% represents a decisive move toward monetary normalization that leaves zero room for market complacency. Across social media and market trading desks on X, sentiment is reaching a fever pitch as investors debate the ramifications of this policy divergence. Traders are actively pointing out that with the yen lingering near 40-year lows, the risk of a disorderly carry trade unwind is very live and active right now. Discussions on X emphasize that more than $70 billion in past currency interventions have already faded, leaving the BOJ with rate hikes as its primary defense against severe yen weakness. Many market commentary posts highlight that a BOJ hike to 1.25% while the Fed sits pat creates a policy mismatch rarely seen in recent financial history. Prominent traders on X are drawing direct comparisons to the August 2024 flash crash, warning that systematic funds and quantitative strategies could be forced to liquidate leveraged positions if currency volatility spikes. The overwhelming consensus among active market participants on X is that any hawkish surprise from Tokyo will reverberate far beyond domestic Japanese asset classes. Financial analysts and institutional strategists are carefully evaluating the structural mechanics of this rare policy divergence. Institutional research notes emphasize that the interest rate differential between the US and Japan has served as the backbone of global liquidity for years. When the BOJ operates at 1% or higher while the Fed holds rates steady, the risk-reward profile of holding short yen carry positions deteriorates rapidly. Swap market pricing of 70 to 72% hike odds by October suggests that institutional capital is already repositioning for higher Japanese yields. Analysts point out that Tokyo is facing an ultimate choice, whether to decisively end the low-rate era to stabilize the yen or succumb to political pressure to preserve domestic borrowing conditions. Institutions warn that if political interference forces the BOJ to yield and maintain lower rates at Japan's expense, currency weakness could exacerbate import inflation. Conversely, a confident rate hike to 1.25% signals a fundamental regime shift in Asian monetary policy. How will a BOJ rate hike to 1.25% impact Japanese equities and specific stock sectors? Historically, a weak yen provided powerful tailwinds for major Japanese export-oriented corporations and domestic stock indexes. However, an aggressive rate hike combined with yen appreciation completely flips this macro narrative. When the BOJ surprised the market in August 2024 with a small 15 basis point hike, the Nikkei 225 suffered a brutal 12% single-day drop as carry trades unwound rapidly. A move to 1.25% could trigger similar downside volatility for export-heavy equities and broad market benchmarks like the Nikkei 225. On the other hand, domestic Japanese banking and financial sectors stand to benefit from expanding net interest margins as benchmark rates reach 30-year highs. Investors must distinguish between export-sensitive sectors vulnerable to currency strength and domestic financial institutions that gain structural tailwinds from higher Japanese government bond yields and normalized interest rates. The spillover effects of a BOJ hike to 1.25% extend far beyond Tokyo, directly threatening U.S. equity benchmarks and mega-cap technology stocks. Global market analysis indicates that foreign investors have heavily utilized low-yielding Japanese yen to fund investments in high-growth U.S. assets. Assets tracked by broad market index funds like SPY, along with tech-heavy benchmarks like QQQ and market leaders like NVIDIA and Microsoft, are identified as being directly exposed to a yen carry trade unwind. If the yen appreciates sharply following a BOJ rate hike and a steady Fed policy pause, the cost of funding these mega-cap positions surges instantly. As hedge funds and institutional traders rush to cover short yen exposure, they are forced to sell liquid U.S. equities, including shares of NVIDIA and Microsoft. This intermarket chain reaction demonstrates how Japanese monetary tightening can trigger unexpected liquidity contractions in Silicon Valley and Wall Street. For individual investors navigating this heightened volatility, disciplined risk management is essential. First, closely monitor swap market odds and official communications from both the Bank of Japan and the Federal Reserve during upcoming policy sessions. Understanding that $70 billion in intervention failed to permanently support the yen highlights that fundamental rate policy, not central bank intervention, dictates currency direction. Second, re-evaluate portfolio exposure to mega-cap technology stocks such as NVIDIA and Microsoft, as well as index funds like QQQ and SPY, which may experience collateral selling during a carry trade unwind. Third, avoid emotional panic selling during sharp index drawdowns, remembering how the Nikkei 225 recovered following the August 2024 flash crash. By holding adequate cash buffers and focusing on sectors with strong balance sheets, investors can protect their capital and capitalize on market dislocations caused by central bank policy divergence. Looking ahead, our AI predictive model outlines 3 distinct macroeconomic scenarios based on the outcome of BOJ and Fed policy decisions. In the base case scenario, assigned a 55% probability, the BOJ hikes interest rates to 1.25% by October in line with current 70 to 72% swap market pricing, while the Fed holds rates unchanged. This results in a measured yen appreciation toward 142 yen per dollar, triggering moderate volatility in SPY and QQQ without causing a systemic financial crash. Japanese bank shares outperform while export stocks face manageable headwinds. In the bear case scenario, with a 25% probability, the BOJ delivers an unexpected hawkish surprise combined with aggressive Fed hawkish messaging, causing a rapid unwinding of yen carry trades. The yen spikes sharply toward 135 per dollar, sparking a repeat of the August 2024 flash crash with a 10 to 15% drop in the Nikkei 225 and heavy liquidation in U.S. megacaps like NVIDIA and Microsoft. In the bull case scenario, given a 20% probability, political pressure forces Tokyo to delay rate hikes, keeping the BOJ at 1% while global markets absorb central bank guidance smoothly. The yen stabilizes near current levels, allowing U.S. equities and Japanese export sectors to maintain their upward momentum. To summarize today's deep dive, first, a BOJ rate hike to 1.25% creates a rare policy divergence with a stationary Federal. Second, over $70 billion in past currency interventions have faded, leaving rate hikes as the primary yen catalyst. Third, carry trade unwinds pose direct risk to Nikkei 225 and U.S. tech leaders like NVIDIA and Microsoft. What are your thoughts on Tokyo's policy dilemma? Leave a comment below, hit the like button, and subscribe to Tokyo Macro for insider analysis on Japanese markets.